One of the most common questions we get at Galileo Capital is this: I'm about to retire, will I still have to pay tax? And if so, how much? The honest answer is, it depends. Some retirees pay no tax at all. Others pay a meaningful amount. And a lot of people are paying more than they need to simply because they don't know what deductions and credits are available to them. Today, we're going to walk through exactly how retirement income gets taxed in South Africa, show you the real examples with real numbers, and make sure you know every legitimate way to reduce that tax bill. Let's start with the basics. When you draw income from a living annuity or receive a pension from a guaranteed annuity or employer pension fund, SARS treats that income exactly the same way as a salary. It's taxed as ordinary income using the same tax tables that apply to everyone. So if you draw 20,000 Rand a month from your living annuity, that's 240,000 Rand a year. SARS will assess you on 240,000 Rand of income. The tax you pay depends on which bracket that income falls into after your deductions and rebates have been applied. The good news is that the tax system gives retirees a meaningful advantage over working people through higher rebates, a more generous interest exemption, and enhanced medical credits. These can significantly reduce, sometimes eliminate, the tax bill on a moderate retirement income. Let's look at each one. The tax rebate is a direct reduction of your tax bill, not just a reduction of your taxable income. And SARS increases the rebate as you get older. For the 2026 tax year, every taxpayer gets a primary rebate of 17,235 Rand. This alone means that if your annual income is below 95,750 Rand, you pay zero tax, regardless of your age. But if you're 65 or older, you get a second rebate on top of that. The second rebate of 9,444 Rand. That brings your combined rebate to 26,679 Rand. At this level, you pay no tax at all if your annual income is below 148,217 Rand. And if you're 75 or older, there's a third rebate of 3,145 Rand. Your total rebate becomes 29,824 Rand, and your tax-free threshold then rises to 165,689 Rand per year, or just under 13,808 Rand per month. What this means practically is a retiree aged 65 or older drawing less than 12,351 Rand per month pays no income tax at all. For many South African retirees, that covers a significant portion of their income, or all of it. It's worth a quick mention. If you're finding the series useful, please subscribe and hit the like button. It generally helps more South Africans find this content. On top of the rebates, if you're 65 or older, SARS gives you an interest exemption of 34,500 Rand per year. This means the first 34,500 Rand you earn in interests from a savings account, a fixed deposit, or a money market fund is completely tax-free. For a couple where both spouses are 65 or older, that's 69,000 Rand of interest income that SARS doesn't touch. With South African interest rates still relatively elevated, that can represent a meaningful amount of tax-free income from a conservatively invested cash portion of your portfolio. This is one of the easiest wins for retirees and one of the first things we look at when helping clients structure their retirement income at Galileo Capital. While we're on the subject, we also send out a free newsletter from Galileo Capital with retirement tax tips, updates when the SARS rules change, a plain language summaries of anything that affects your pocket. The sign-up link is in the description below. It takes about 30 seconds. The third major relief for retirees is the medical aid tax credit. If you're on a medical aid, SARS gives you a credit, a direct reduction of your tax bill for every month you're a member. For 2026, that credit is 364 Rand per month for the principal member, 364 Rand for the first adult dependent, and 246 Rand for each additional dependent. So a couple on medical aid gets a combined monthly credit of 728 Rand. That's 8,736 Rand off their tax bill every single year. But here's what many retirees miss. If you're 65 or older, you can also qualify for an additional medical expense credit. This covers 33.3 cents in the Rand on all qualifying out-of-pocket medical costs. Specialist visits, chronic medication, co-payments, dental, optical, anything that's not covered by your medical aid. Given that healthcare costs tend to increase significantly in retirement, this additional credit can be substantial. It's worth keeping record of every out-of-pocket medical expense through the year and claiming it on your annual tax return. Let's put this all together with a real example. Meet Thabo. He's 67, retired, and draws 20,000 Rand a month or 240,000 Rand a year from his living annuity. He and his wife are on a medical aid together. He also has 400,000 in a fixed deposit, earning about 28,000 Rand a year in interest. Step 1, his taxable income. His annuity income is 240,000 Rand a year. His interest income is 28,000 Rand, but the first 34,500 is exempt, so the full 28,000 is sheltered. Taxable income is 240,000 Rand. Step 2, the tax before rebates. On 240,000 Rand, using the SARS table, the tax would be approximately 37,614 Rand. Step 3, subtract the rebates. Thabo is 67, so he gets the primary and secondary rebates combined, 26,679 Rand. Tax after rebates, 10,935 Rand. Step 4, subtract the medical credit. As the principal member with one dependent, he gets 728 Rand per month or 8,736 for the year. Tax after medical credit, 2,199 Rand. So on a retirement income of 20,000 Rand a month, 240,000 Rand a year, Thabo's annual tax bill is approximately 2,199 Rand. That's less than 184 Rand a month, less than 1% of his income. This is why understanding the tax system matters. Without the rebates and credits, this bill would have been over 37,000 Rand. With them, it's a fraction of the cost. One more thing before we close. If there's anything we've covered today that raises a specific question about your own situation, don't sit with it. Get in touch with us at Galileo Capital. The contact details are in the description. We'd rather you'd ask than make a costly decision without the full picture. To bring it together, retirement income in South Africa is taxed as ordinary income, but the rebate system means that many retirees on modest incomes pay very little tax, or none at all. The keys are knowing your rebates, using the interest exemption, and making sure you're claiming every rand of your medical credit, including out-of-pocket costs. The numbers in today's example are real. The system does work in retirees' favor, but only if you know how to use it. In the next episode, we're going a level deeper on medical expenses, specifically how to claim the additional medical expense credit and what qualifies as a claimable cost. For retirees with significant healthcare spending, this can be worth thousands of rands a year. Make sure you're subscribed so you don't miss it. And if you have a question about your own tax situation, retirement, leave it in the comments below. We read every one and it helps us to decide what to cover next. This video is for educational purposes only and does not constitute personal financial advice. Tax laws change. Always verify current figures with SARS or consult a registered financial advisor for advice into your specific situation. Our goal is simple: to help you retire with peace of mind. Until next time, cheers.